Hello and welcome to M&A Murders and Accusations, the good, the bad, and the ugly of selling your business. We dig into what you need to know and how not to kill the sale of your business. Now here's our host, Rick J. Krebs, Mergers and Acquisitions Advisor.
Hello, everyone, and welcome to M&A, Murders and Accusations, the good, the bad, and the ugly of selling your business. We're trying not to kill deals, and so today we're going to talk about the good, and I'm really excited to have my guest speaker. My guest speaker is Eric Veve. Hello, Eric.
Hello, Rick. How you doing?
Doing great. Thank you. Eric is a friend, and we've been working together, I want to say, going on 10 years now, I think.
Yeah, that's right. Yeah, it's about time flies. That's crazy, but I think you're right.
How we got acquainted was I was working on an oil field transaction over in Colorado, northern Colorado. I don't remember if you reached out to me or I found you. Somehow we found each other. And I had this oil field transaction. It was an $18 million deal. And just picture an old trucker discovering that he was going to have to pay 30% of $18 million, which is $6 million. Just think about, and I can't even repeat the words that came out of his mouth, the expletives and the swear words. He was just so angry when he found out that Uncle Sam was going to take a third of his business. It's like, I've been paying Uncle Sam every year all along. He was so mad and so angry. And Eric came in and we introduced the client to this structure. And it was a game changer for them. They accepted an offer, and the transaction was much different after they had learned about this structure. So this is a good part of it. I'm really excited to have Eric talk about what he does. And so let's start, Eric. Tell us a little bit about yourself, a little bit of background, and how you got started with what you do.
Yeah, thanks, Rick. And I still remember, I remember that transaction, and the person you're referencing is still a client. It's nice to hear you just put words to that. I remember it, and for that client to respond that way, he's a great person. So he was upset, but rightfully so. So how I got started in the industry, I started in the financial services industry about 20 years ago, working successfully for corporate America and kind of moving through the ranks of corporate America, large companies, MetLife and Fidelity, and really decided that wasn't for me. I didn't want to keep pursuing that corporate avenue, wanted to meet my clients differently, and so started in the independent wealth management field. And as I had success with my clients in that space, I started realizing that what they were more concerned with was taxes. It really became a theme. Anytime I was dealing with somebody in that high net worth or ultra high net worth space, it was like, geez, I mean, I think, wealth management's pretty cool, but my clients are more concerned with taxes. So that theme continued, and we started building the business, really focusing on taxes to meet our clients in that way. That's how we have our tax and wealth management company today. It's really been an evolution. I didn't think that we would lead with taxes when I started this company 12 years ago. But now I think as I'm speaking with people, as I'm telling people what I do, we really lead with taxes because it tends to resonate with our audience.
Yeah, and most people, right? So I failed to mention Eric Veve is a managing partner at EpiQuest, and that's a wealth management firm, financial planning, but what do you consider it?
Yeah, I would say tax and wealth management.
Tax and wealth management. And so we're going to talk about saving on taxes. It's not an elimination of taxes, but it's a saving of taxes. So before we get into it though, Eric, I always like to have my guests tell a little something cool about yourself that maybe not a lot of people know. Maybe you like to play golf, or maybe I don't know. Tell us something cool about what you like to do in your spare time.
Well, I'll tell you the coolest thing about me is my family. You're not going to ask me an open-ended question like that with without hearing that I'm married for 24 years, what will be 25 years this coming April.
All right.
3 kids, a 23-year-old daughter, a 21-year-old daughter, and a 20-year-old son. The coolest thing about my kids right now is my 23-year-old just got engaged. She'll be off the payroll soon. That's kind of cool.
You hope. Maybe you're adding one.
That's been a real blessing. And then my son right now is actually at semester at sea. He called right before this interview, Rick. And so I'll be calling him back when we're done. He's in Malta right now. He's enjoying his junior year, one of the semesters of his junior year, on essentially a cruise ship. He takes classes during the day and then they port at these various different countries, and that's pretty cool.
Wow. Very cool. Very cool. So Eric is in Colorado, and I've done quite a bit of work in Colorado, and that's how we met. But he's in northern Colorado. What's the town again?
Our company is in Broomfield, east of Boulder. I'm looking out my window here and I have a beautiful view of the mountains. I can see Long's Peak, and when I walked in this morning, it was 72 degrees. So,
oh, beautiful. All right. So let's get into it here. So the asset exchange, help us understand, what is the asset exchange and the purpose of that company?
The asset exchange really is a structure that is designed to bring value to somebody who's selling an appreciated asset. It's a structure that allows that individual, similar to the one you described earlier, who was selling an appreciated asset, to gain a couple of benefits. 1, asset protection. 2, capital gains tax deferral.
Gotcha. And this is what we're talking about today, is for capital gains. We can't do anything with ordinary income, right? A lot of people get the word deferral confused with elimination. So talk about the difference between the two, if you wouldn't mind. What's the difference between a deferral of taxes and an elimination of taxes?
At its core, I would say one's allowed and one really is frowned upon in a structured sense. So typically you're not going to see the structuring of a sale, which is what we're doing, breaking one sale up into 2, which we can talk about later. But when you're structuring to use the code, you're really never going to be eliminating taxes. You're really just going to be deferring them. And so if we're deferring taxes, you know you're working within the code to accomplish it. If you're eliminating taxes, usually you're doing something that the IRS is really going to be concerned with.
That's right. And I think that's a red flag. If someone's telling you that you're completely eliminating taxes, like in that transaction, $18 million sale and $6 million in taxes. If someone comes along and says you're going to eliminate that $6 million bill, some red flags should go up with clients. They should be going, ding, 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 whoa, that all sounds great, but the IRS may have a problem with it, right?
Totally agree. Yeah, we're not interested in, and we're advised, we take that position with clients at times, right, as advisors, to say, you might want to pump the brakes on that conversation. Here's some other questions you might have. Yeah.
Yeah, exactly. Because the last thing we ever want to do is have a client that does something that's going to get them crossways with the IRS, right? That's going to be subject to audit. You and I have done, probably half a dozen of these transactions successfully. Clients very happy. And I think one thing to make very clear is this asset exchange structure is not something new. It's not some loophole. It's taking what's already there and applying it in a new way. And I'm going to let you comment about that, Eric, a little bit. You know that better than I do. So tell me a little bit about that.
Yeah, I think you're right. It is important to know how we're accomplishing something. And if you're familiar with section 1031 of the code, it's fairly vanilla section of the code. There is an opportunity, I guess, if you want to manipulate that code and not structure the sale of your real estate properly, not have a true third-party intermediary, not obey the guidelines that the IRS has given you to increase the benefit, I guess you could do that and hope that the IRS doesn't see it.
Yeah.
Or you could do what they're telling you to do and just use 1031, the code. That's the important thing to remember about Section 453, which is the section that we use for our structure, and that governs installment sale law. As long as you're using that code properly, obeying what the IRS deems as reasonable, commercially reasonable, then you're using the code. I think what happens sometimes in a marketplace is a practitioner will want to say yes to everything so that they gain more clients. That's something that we're concerned with. And so sometimes we say no, that doesn't work. Here's why we think that's important. Here's why we think that leaves you vulnerable. But at the end of the day, the answer is no. And we like that we're willing to do that we're willing to say no. We think that it improves ultimately the position of our clients, both past and future. And so important to know, we are just using the code for what the code allows.
Gotcha. So this isn't some big loophole or something that's new. I would say there's black and white and gray, and it's not even in the gray. I mean, it's white. There's no things that are out there, things that are going to make people additionally subject to audit, and it's had some scrutiny. So let's back up a little bit and talk about the structure and how it works. Just, let's say that it's a $10 million sale. Walk me through the numbers and how it would work, Eric.
Yeah, and let's just assume for the sake of our example that all of that 10 million is capital gain. If a portion was some other kind of income, it's more nuanced. So we'll just use that example and assume that it's all capital gain that's going to be recognized by the seller of that asset.
Perfect.
At a 10,000 foot view, the seller of that asset would sell their asset to our trust structure in exchange for a promissory note. No different than they could do with somebody other than our structure. People sell assets in exchange for promissory notes all the time.
Yep.
Code exists to facilitate that transaction. They would be operating under Section 453. So that's how they're operating under Section 453 that allows that transaction to take place from a tax standpoint. And they receive that promissory note with terms that they get to define. Let's just say, for sake of this conversation, they choose a 10-year term. So now they're in possession of a note that owes them $10 million over 10 years. The trust is in possession of their business in this example, okay? The trust is in possession of the widget company, and the trust is going to sell it to an ultimate purchaser, likely whoever the client was going to sell it with without our structure being in place. The person who's willing to pay $10 million in this example cash, because you did a good job as a business broker, and they're bringing $10 million of cash. I wish we saw that deal all the time. But the purchaser is bringing $10 million of cash to the closing table. The trust is bringing that widget company to the closing table in exchange for that $10 million. So now the trust holds that $10 million. In exchange, they give the company to the ultimate purchaser. The ultimate purchaser's happy. They got what they wanted. They have the widget company. The client, the original seller, has what they're looking for, which is income coming from that $10 million. Capital gains tax deferral. So think of, several of the clients that we've worked with are moving into retirement. The client you referenced earlier was, and now that individual has the full sales proceeds working for them, producing income rather than maybe only 2/3 of those proceeds working for their benefit.
So I think this is a really important point. So they get to utilize pre-tax dollars. So in this case, instead of 7 million working for them, they have 10 million working for them, right? And you run the numbers on that, and it makes so much sense because there's so much more money working for them, more money in their pocket. They're still going to defer the taxes, but I love that. Sorry, I wanted to interrupt you, but that's such an important point, the utilization of pre-tax dollars versus post-tax dollars.
We've seen that work, right, Rick? Like we've seen examples where a client has to swallow that pill and they're like, wait a second, I had it in my mind that I was going to get $10 million or whatever the number is. And all of a sudden they have this kind of come to Jesus moment and it's like, wait, I don't get what I'm selling for? That changes everything.
It's a game changer. And sometimes they can't sell. So, they're looking at deferring, not eliminating, but deferring their retirement time, right? They work a few more years till they can pay the taxes. So I love this structure. Love the notion of pre-tax dollars at work for clients versus post-tax dollars. Very powerful.
That's right. Yep. That is what the asset exchange is providing. That's right.
Gotcha. And I think the other thing that's important, because as a business broker, M&A professional, when the buyers find out about it, they have some questions. And their biggest questions and concerns are, what rights am I losing? And from a buyer's perspective, they don't lose any rights. They get the same asset. They get the same reps and warrants from the seller. And so there's no change from the buyers. And so you and I have spent a lot of time educating buyers about this. I teach classes to CPAs about this structure. And the buyers like it. Their first question is, what do I lose? And once they understand what they don't lose, their next question is, well, can I do it when I sell? I love that. Like, yes, you can.
Yeah, that's you're right. And we've walked through those questions with every client. Really, I think we could probably just start handing them a sheet of all the questions we know they're going to have, because we've done it enough times. But sure, that what am I losing in this transaction when I buy this? And reps and warranties is a big one, right? And the historical seller is going to sign off on those the exact same way they would have otherwise. And then the purchaser gets exactly what they would have gotten. That's when we walk through this process with a seller and a purchaser, it really never is the purchaser. Once they understand, and your sophisticated purchasers have maybe even interacted with this before, we're not delaying the close because of those questions. We're very used to interacting with the purchase side team. Our team is excellent at managing those questions. We also realize every transaction is brand new for the person doing it. Yeah. So we're very thorough. We're not rushed. We're very complete and willing to take the time to get them to that place of comfort. But ultimately, everybody finds themselves there on the purchase side. We get it. Thank you. Let's move forward.
So tell me, you talked about the team. Tell us about the asset exchange team. Who are those members and who can the seller expect to be working with?
So initially they work with me, and we work really well with you. That's been your experience. So we let you tell us. Let me just start by saying that you're kind of the ambassador of that relationship as far as we're concerned. So typically you're going to introduce me, and we're going to come in and educate them at kind of a 10,000 foot view. I'm very used to talking to clients in that way. I'm able to meet them without all the legalese and without all the nuances of the tax code. It's like, Eric, do you understand what I'm trying to accomplish? Will you communicate to me in a way that allows me to understand that you're going to achieve this for me? So we have that conversation, answer any questions that they have generally. If they're saying, okay, this is something I'm interested in, then we'll start to bring in other team members like Russ Lombardi, tax attorney. Well, I think I've worked with Russ for almost 15 years now. Great guy. Yeah, there isn't none better than Russ. He's great. So we bring Russ in, and oftentimes then the seller's going to have their counsel wanting to get engaged in the conversation, and their CPA start to get engaged into the conversation. So we'll bring all the professionals around the table and answer their questions as well, which usually includes Russ, the tax attorney, and Dufresne and Million, the CPA firm that's responsible for all of the accounting, because there's going to be those questions too, right? What about the tax consequence? Who does the reporting on a moving forward basis? Oh, wait, it's not all capital gains. We have some depreciation recapture. What are we doing there? Oh, wait, we have this $1 million that we owe. How does that get paid off at the closing table? So we start to work through all of those dynamics. But initially it's me. And then as the client has more interest, we start to bring in other members of our team and their team.
So at a minimum, you have a business broker or M&A professional. We have you as the wealth manager. I want to say financial planner, but that doesn't really describe what you do. You invest the money. You're a registered investment advisor. The trustee appoints you to manage the money. Mm-hmm. And then we have Russ Lombardi, who is the attorney, and he's the structure guy. He's the guy that puts all the legal paperwork together and makes sure that it's copacetic with the IRS code, that we don't have any issues there. And then we have another guy, which is a CPA, Doug Deferring.
Yeah.
Right. He does the accounting for the trust. So it's interesting that the team members that are required, each with specialized areas of expertise. So it's not something that I think one person could do. It takes 5 or 6 different individuals who each have expertise in certain areas to be put together as part of this team that will be working for the client.
Yeah, that's right. And yeah, I think you're touching on something there that's really important. And I'll identify, you said the trust company or the trustee, and then you mentioned different members coming together to provide this solution. One of the things we've seen is that a single entity or organization will try and be all of those people to make it, let's say, easier to facilitate the transaction. And actually, there's a nuance there that the code doesn't like. There really does need to be these levels of separation between the trust company and me and the client and you, right? So bringing all of those people together is actually really important as far as the code is concerned.
Gotcha. Arm's length transaction, right? You can't manage your own money within the trust or have your sister do it, for instance. It's got to be someone who's licensed to do that, who's appointed by the trustee.
And so who's providing that service to others in a commercial way.
Yeah, in a commercial way, exactly. And not going to let you take that money that's in the trust and invest in crypto, for instance, right? We're highly risky because the trust has an obligation to the buyer or to the sellers through the note. So tell us a little bit more about that note and how it works, because that's a big question sellers have is, how am I going to get paid? Where's my money coming from?
Yeah, so that note, we'll just go back to that $10 million example. Mm-hmm. So now the client is holding on to that 10-year note. They said, okay, I'm interested in deferring this obligation for 10 years. They could have said 5. We've had clients say, you know what, I'm only comfortable looking down this horizon for 5 years. Well, then they would be holding on to a 5-year. We've had other clients say, I'm comfortable. I'm going into retirement. I'd like to do a 20-year term. They're in control of that time period. So we'll use 10 years for our example. And then think of the retired client. I'll use them in this example. Mm-hmm. What were your goals without this structure? Mr. and Mrs. Jones, we'll call them. What were your goals without this structure? Well, Eric, my goal was that I'd sell my company for $10 million and I'd have a $400,000 income. That gets it done for me. Okay. I'm storing that information. I'm like, okay, I think I know what we need our trust note to look like. We need a note that's going to pay Mr. and Mrs. Jones $400,000 because that's what they wanted in retirement. So think of the note as a vehicle to give you what you wanted, and then we fill in the terms accordingly. So now what Mr. and Mrs. Jones have is a note that pays them $400,000. Maybe on a monthly basis, they're receiving the portion of that $400,000 annual payment. They're enjoying their retirement. The $10 million is invested in that trust to what they are comfortable with as the lien holder of the balance. They get to say what they're comfortable with those dollars being invested in. I come to the table and say, Mr. and Mrs. Jones, let's have that conversation, just like I would with Mr. and Mrs. Jones without the structure. Let's say you have $10 million. What are you comfortable with? We have that conversation that I'm used to having in my wealth management company without that structure. The plane gets landed on what Mr. and Mrs. Jones are comfortable with, so they know that their dollars are invested the way that they would have been invested if they only had $7 million, right?
Yep.
Now they have $10 million invested, obviously producing many more dollars for them in retirement, and we're doing that for the term of the note. At the end of the note term, they have a decision to make. Do they want to keep deferring? Do they want to pay the tax and do something else? They have a decision to make. Of course, most of our clients are saying, I like this. Let's keep deferring.
They do, unless they need it, right?
That's right.
So as they receive these payments, quarterly, monthly, annually, they kind of have some flexibility, right, on how they receive
Yeah, it's totally up to them.
So they're going to pay tax on the payments as they're received from the trust.
Yeah.
So it's just like an installment sale, like when you sell a piece of real estate on an installment basis, right? It enables you to do some planning there with taxes, put some of that money down into the lower tax brackets in the future. And they only pay tax as it's taken out of the trust. I think that's really important for clients to know also.
Yeah, and you've touched on something there, Rick, and I know this is a podcast, so we won't get too far into the weeds, okay? But you touched on something. I'll try and do it justice because it really creates some additional benefits to the economics of this.
Mm-hmm.
So let's say that I have a client that has a need for $500,000 of income, and I have a $5 million note in this example, okay? I could take I could create a 10% note. 10% of $5 million is $500,000. I say, great, Rick, I solved your problem. You said you wanted $500,000 of income. I made your note a 10% note. You're going to receive $500,000. Problem solved, right?
Mm-hmm.
Well, what I would do instead of that is say, Rick, current interest rates allow your note to be as low as 5%. So stay with me here. Current rates allow it to be 5% or $250,000. I know you need the 500. Let's make special principal distributions of the remaining 250 to bring you up to your $500,000 of need, right?
Mm-hmm.
Now, what did I do? The $250,000 is going to be recognized, as you stated, the interest component as income, right? That's how the interest is taxed. But how is the other $250,000 taxed?
That's going to be taxed at capital gains, right?
Which is lower.
Bracket.
Is then our ordinary income bracket. So now I've given the client what they needed, but more dollars of the 500 to spend, haven't I?
Love it. Yep. Yeah. Love it. And not only capital gains, but there's a basis in the capital gains. We haven't even talked about that, right?
So if there's basis in the gain, they're not paying any tax on that, right?
Yeah. Yeah. And so clients don't lose their basis. That's another question we get oftentimes is, do I lose my basis? And no, the nature of the tax moving forward transfers and is paid on an installment sale basis, but they don't lose that basis by doing this structure.
And think of one more thing in closing, Rick, because usually you have your highest income years are when in your business?
The last years, right, before you sell.
Exactly, the year that you sell. And then you know how the brackets work with capital gains. You go from, there's actually a 0% bracket, there's a 15, and then there's the 20, right?
Yeah.
So oftentimes what we're seeing when we model these scenarios out for clients, we're actually taking them from what would have been 20 because their income was high in that year that they sold their business, right? Not only did they have high income, they had a $5 million sale. So all of it's flowing in that year to the 20% bracket. Now, when I start to model out what I just described, it's like, oh, wait, you mean we're going to pick some of this up in the 15, maybe all of it in the 15? That's a tax savings, not an elimination, but a tax savings. And the economics of that are just accretive to the total value that we're bringing to clients.
Yep. Exciting. Very exciting. So a couple of questions. Clients ask me this all the time. They're like, well, why haven't I heard of this before?
Yeah. Yeah. Well, I think one response I've heard is, well, how many businesses have you sold? I mean, maybe you've never sold your business before. That might be one reason. If you have sold a business before, I'm guessing you've probably heard of something like this because we talked about it earlier. When it comes time to sell your business and the tax man glides the bill across the table, hey, you asked me to tell you what the consequence of this is going to be. Brace yourself. You start looking. You start finding out what options you have. So that's probably the main reason. You've been building your business. But when it comes time to sell your business and you're faced with this obligation, most people have heard of something like this. In my experience, most people have.
Mm-hmm. And sometimes,
right? It's nuanced. The IRS isn't sending out any notices about how you can do tax deferral either. That's not what they're in the business of doing. It's like up to us to try and figure out, hey, I know there's this code out here. How can I use it? But they're not going to tell you, hey, you know what? If you'd like to defer this liability, here, call Eric and his team. So I think it just takes some time to say, okay, I'm going to gain an understanding of the options I have. And if you take that time, create that space, and in my experience, probably everybody is going to discover an option like this.
I think so. And a lot of people, like their CPAs don't even know about it because they're doing the books for ongoing businesses. They're not involved with sales very often. And I think another thing also is as you reach certain levels of money, it opens up windows for you to have you more sophisticated structures and better structures, I want to say. And a lot of people, they just haven't had this type of money to be able to afford this type of advice before until they have this big, kind of once in a lifetime event.
There you go. That's right.
Yeah. A couple other questions real quick.
Yeah.
So what are the risks to a seller? What do they need to be aware of?
I would say primarily they need to be aware of who they're choosing to provide a service like this. If you've made the decision to pursue something like this, really you need to find a firm that's done the work to make sure they are in compliance with Section 453. You do not want to find a firm that's just going to say yes to every question you have, because I think you referenced it earlier. The IRS is paying attention to providers of structures like this that are just cutting corners. We referenced that earlier also. You know what? I think it would be easier, Rick, if we just started our own trust company.
Yeah, manage our own money.
Let's just start our own trust company. What are we doing here? I gotta go find somebody who wants to provide this service. I gotta find somebody out there in the universe of trust companies that understands and has taken the time and done the due diligence to vet our structure. Nah, let's not. So it's making sure you're asking the tough questions that put the structure in compliance with Section 453. Because if you're not, I would say the list is long about things you need to worry about.
So when people are considering this, how soon do they need to do it? I mean, is an LOI prior to the LOI, when they open the doors of the business, how much time does it take to do the structure?
Well, you've done such a good job in what you've created over there. I think the sooner the better, right? And I know you're jokingly saying when they open the business, but that's probably when you want to start talking to them. It's like, it's never too early to start planning for your exit, right? And so when do we need to come into the picture though? I would say, probably around the LOI in our experience, because once you know the terms and conditions of sale, you know what the consequence of that sale is from a tax standpoint. right? So usually that's when you have your team start evaluating the economics of that offer. And you say, oh, that means I'm writing a rather large check. In comes the asset exchange to talk to you about how you might mitigate that.
LOI or pre-LOI. I don't know if you recall, we worked on one about 5 years ago, and they wanted to do the structure. They were about a week from closing. They had all of their closing documents drafted and everything, and they ended up not doing it because the attorneys didn't want to have to redo documents. It was kind of too late. So you don't want to be like them, right? And they lost out, if I recall, it was $4 million in tax deferral. And what ended up happening is they created a couple of nuances in there that enabled them to treat it as an installment sale. So they kind of had a little bit of benefit. But we lost out on that one, and they lost out because they waited too long.
Yeah.
And you don't want to do that. One other thing, security on the note, because they're going to ask about the security. Tell us, how is that seller note secured?
Yeah, it's secured by a collateral assignment. So there's a collateral assignment placed on the note, securing the assets of the trust. Also, the trust company itself is domiciled in Nevada. We choose Nevada because really it is the best state in the country for securing wealthy clients' dollars. So the state of Nevada does an excellent job. There's billions of dollars held in trust companies inside of Nevada. I won't get into the details of what Nevada does to protect the general public's wealth, but they do an excellent job of governing their trust companies, because at the end of the day, this is a brick and mortar trust company in Nevada. You've been there. You could walk into the building, say hi to James Chris, the trustee that we use on these structures. It's a real brick and mortar location. I think that's important. So it's a trust company, brick and mortar in Nevada, lots of governance there from the state of Nevada. Then we custody assets at TD Ameritrade, which is actually becoming Schwab. So I'll start saying Schwab, Charles Schwab. And there's the benefits that every client who uses Schwab, all the security that's in place when you have a discretionary account at Schwab. The industry's done a good job ensuring people can't abscond with your money.
Yep. And in order to, this is something I found out that was really cool, was money can't be taken out of the trust without the permission of the seller, right? It requires 2 signatures to do so. So there's no Bernie Sanders deal going on here. There's just no way that's going to happen. It's locked tight and very secure, because that's a big concern that people have. Sellers, they're like, okay, tell me where my money's at. How is it secured?
No different than if you came to me, Rick, with your own dollars, right? You have control of those dollars. And as a lien holder, that's a real thing. So yeah, you're absolutely right. That's not how, that once you are comfortable and kind of understanding what is real in that environment, we are never not satisfying somebody's questions and concerns about that. So that there's really no risk there. You're invested, so there might be investment risk, right, inside of the portfolio, but the client, again, is in control of that as well, because they're the ones who are choosing the theme of that portfolio.
Makes perfect sense. And this is something that we don't talk about a lot, but before we go, it's the asset protection part of it. So what I'm seeing is clients have a lot of money locked up in their business, $10 million, for instance, right? They sell the business, and so that is converted to cash, and that cash goes into their personal bank account. Well, in your personal bank account, it's exposed to a tremendous amount of risk. Well, these assets are not that. They go into a trust, and they have this additional protection, and I love that aspect of it.
Rick, if I'm presenting, and I know Russ, because the tax attorney who's responsible for structuring this, he's a tax attorney. Like, what you're describing is like the theme of how he brings value in his practice. And it's a real thing. And the more wealth you have, the more what you're touching on becomes real.
Yeah.
Somebody slips and falls on your sidewalk after you've spent a lifetime building that widget company, and you've got $10 million in your bank account. Do you think they're going to spend the time to find out how expensive that slip and fall is going to be to you? You're darn right. Like,
yeah.
I think my neck really hurts. Yeah, I think I'll never be the same.
Mm-hmm.
So asset protection can't be, if I were to stack rank it, honestly, I would put asset protection right next to deferral and maybe above it. Because if you lose the $10 million, what was more valuable? The asset protection or the capital gains tax?
Yeah, the protection. Absolutely. And people aren't talking about protection.
Because it's not something that they're used. But guess what? We all have businesses. If we're talking about this, we were business owners. What do we do in our businesses? Once you get large enough, you start paying attention to your liabilities.
Absolutely.
Right? We're both business owners. We know this. Like if I'm losing sleep, it's because of that conversation. It's like, I have a legitimate asset here and I need to look at protecting it.
Mm-hmm.
But then you go to sell it and it's actually most vulnerable when it's $10 million sitting in your checking account, isn't it?
Yeah.
It's like the most vulnerable place you can put that asset. So asset protection can't be understated. It really can.
I agree 100%. So Eric, we're short on our time. Actually, we're on our time. But how do people find out about this? How do they learn more?
Well, first they'll work, with their business broker. Hopefully their business broker is going to make an introduction to you, and you facilitate kind of the early part of that conversation and introduction. The asset exchange is easy to find online, assetexchangeexperts.com. And then we start the conversation that we referenced earlier. Educate. That's one thing I want anybody hearing this to know. We really want to be a source of information and to educate. So if you're even just considering a structure like this, use us as a resource. We'll give you the tough questions. Okay?
Love it. And I think it's important. This is a structure that does work, but there's times when it doesn't, right? It doesn't make sense. Or maybe you use part of the money and put into it. You don't have to put all of it into it. You've got a lot of flexibility.
Rick, I'll tell you this just in closing. I would say that of 10 deals that come to us, maybe not as many as half, but maybe close to half, we're just educating. And we're, Mr. and Mrs. Johnson, this doesn't make sense based on your goals and objectives. What you just told me, Mr. and Mrs. Johnson, is that you'd like to take the sale. Here's one from 2 weeks ago. We'll call them Mr. and Mrs. Johnson. Mr. and Mrs. Johnson, you're telling me that you'd like to take the sales proceeds and go invest into another business. Well, if that's your goal and objective, we're not a good solution. That's okay. I don't blame you for wanting to know whether or not you could use this structure and buy another business inside of it, which you can't. Some of our competitors will tell you you can run, but you shouldn't do that. And so they leave that conversation feeling informed and prepared to go start their other business. It's great. We love doing that. On the other hand, every now and then, we have a client like we had a couple of months ago. Here are my goals. I'd like to start that new business. I have some philanthropic interests because I'm having this liquidity event, and I want to take money off the table and plan for future retirement. Guess where we fit into the equation? Taking chips off the table, taking a portion of the sales proceeds, using this structure for future goals and planning, taking some money to start that new business, taking some money in a charitable remainder trust, and doing the philanthropic goals, and great. We were a part of their total solution.
Love it. So Asset Exchange, what's the website and phone number? How they get in touch with you?
Yeah. www.assetexchangeexperts.com. And you can find all of our contact information there. And a really nice, I'm going to point people there for a video that we have, Rick. It's an excellent video that does a good job educating. So find the video there that takes, I think we use in our example, Mr. and Mrs. Jones. I think it does a great job giving a nice illustration from start to finish and encapsulates really the conversation we've had here today in a really nice, colorful way.
Perfect. Sounds great. Thank you, Eric. Always a pleasure to talk to you, my friend. M&A, murders and accusations. The good, the bad, and the ugly of selling your business. Today, it's the good. How to save money on your taxes. Thanks for joining us.
Thank you for attending our podcast. We invite you to join us for future episodes of M&A, murders and accusations, the good, the bad, and the ugly of selling your business. You can also visit us at www.bsalesgroup.com or email Rick directly at rick@bsalesgroup.com.